Welcome to the Q2 2024 Wespath Market Update. My name is Joe Halwax, Managing Director of Institutional Investment Services, and I'm here today to talk to you about what we have in store. You're going to be saying goodbye to some old faces, but then also meeting some new faces. You're going to see our new Director of Public Markets while also seeing interviews with our outgoing Chief Investment Officer, Dave Zellner. We're going to talk to you about what happened in the markets and what happened with Wespath funds. And we're also going to update you on some shareholder and proxy voting with an engagement we had with Mondelez. So thank you for joining, and let's get started.
Hello and welcome to our investors and webinar viewers. My name is Frank Holstein. I'm the Managing Director of the Investment Management team here at Wespath. I'm joined by a couple of my colleagues. First, a familiar face, incoming CIO Johara Farhadieh. Welcome, Johara, and thanks for being here with us today. And next, a new member of our team, Hua Kwok. Hua, thank you so much for joining us for your first quarterly webinar. Let's start there, Hua. Just a couple weeks ago, you joined Wespath as our Director of Public Markets. What led you to Wespath, and what have been your first impressions of the team?
Well, Frank, as I think about my career, I think the different steps I've taken have really led to this place, and the culmination of those experiences are really signing me up for the opportunity here. In the past, I've been an asset allocation consultant. I've worked on client service for an asset manager, and I've been managed portfolio hospitality and natural resources for a Talbot fund. I've invested 20 years in Azure research, and my most it is just with a recent job as a portfolio manager for equities and fixed income for a faith-based investment firm. So I think all those experiences are just perfect for what you're looking for here at Wespath. And on a personal note, it's also a full circle moment for me too. You know this, and Johara, you know this too. My family came to America from Vietnam back in the late 1970s. We actually spent some time in a refugee camp in Hong Kong, and it was a Methodist church in Indiana that sponsored our family. So I just feel like now I'm working for the Methodist Church again after they've done so much for my family. So I think it's just a really great place to be for both on personal level and professional level.
Thank you. Wow, that's wonderful.
And in terms of, I guess, the first impressions of the place, I have two former colleagues that work here, and they're wonderful people. And what I've come to see is that everyone I've met at Wespath is just like them. So I'm so excited to be working with such a great team of just nice people, but also very experienced and smart people. So it's very exciting.
Absolutely. I felt the same way when I first got here. And so to hear you saying it as a new person really just affirms that we have such a great culture here.
Well, and there's probably a question here for you too, Johara. We actually expanded our investments team to add Hua. Maybe you could tell us a little bit why now was the right time to expand.
Sure. So really what I was thinking about, you know this, Frank, I just wanted us to have the ability to enhance our investment strategies as we continue to grow, as well as have the opportunity to have strong portfolio construction capabilities. In setting up this role, I knew we were going to be looking for someone who had, a deep bench, the 20 years of research that Hua has on investment managers. I was really looking for someone that didn't just need the database to find investment managers, someone that had relationships and networks, because I think that's where you really find those top tier niche managers. They're not really in the databases. They're those individuals that are at larger asset management firms that you're very familiar with, that end up leaving to sort of become entrepreneurs and start their own firms. And I know Hua knows a lot of those relationships, so we're really lucky to have you and excited that you're part of this team.
Thanks, Johara. We definitely both agree that Hua's experience is going to be a great asset for the investment management team. As Hua's hitting the ground running, we're also nearing August 1st when Dave will retire, so you'll be taking over as CIO. So you're also hitting the ground running. What types of things will you be prioritizing alongside Hua in the short term, and what are those initial priorities that you're looking to focus on?
Sure. So I would say that I have been hitting the ground running since October 1st when I started, so I'm still running. But some of the things that I think we'll focus on is like revisiting our investment philosophy, not necessarily to make changes, but probably to put it more in my own voice where the foundation's there, but I think there's time for us to sort of revisit that. The other piece that I would say is important to me going forward is to bolster our research capabilities. In promoting Raj, I really wanted to be able to do research that really supported our fund construction. And so spending time on that, spending time on our fund construction, our asset managers, alongside, spending time with the team, really sharing and getting more collaborative and being able to hear from everyone what their best idea is and sort of have a healthy dialogue. So there's a lot to do, I would say, but I think we're, again, building off of a wonderful foundation, and it's just a matter of like, is this set up right for the future for our clients? The other piece that I think is important to note, Frank, is, and you've heard me talk about this, it might be a little bit newer to you, Hua, but I really want to give our investors more choice. And so I think that's really important for us to assess what are the needs of our clients and what are we offering to ensure that we're, meeting those needs. So, like I said, there's a lot to do, but I'm confident that we have the right team going forward, and I look forward to working with both of you on this stuff. Hua, let me ask you a question. So what do you want to focus in on in the short-term period?
On the short term, Jahar, I will review everything that we're doing. I will review the demand. I will re-verify the strategy. I will make sure that we have investment managers leading out to find the strategy so that way we can set up to deliver performance to our investors.
Thank you both. This will definitely be a collaborative effort for the entire investments team. It's the three of us in front of the camera today, but it'll be all hands on deck for these priorities going forward. Thank you so much.
Thank you, Frank.
I'm joined now by my colleague Karen Mansko. Together we'll be discussing both markets and Wespath fund performance. Welcome, Karen. The second quarter was another strong quarter where most U.S. and non-U.S. stocks continued their upward momentum. Some sectors even experienced multiple new all-time highs during the quarter. Let's pull up the charts for trends. What are your thoughts?
The markets looked a lot like they did in the first quarter, where we had strong markets that were led by U.S. markets over international. The same holds true, where just a small number of U.S. stocks, such as NVIDIA, Amazon, Tesla, and Apple, were responsible for the bulk of the market gains. As we can see on the slide, we continue to see growth stocks outperform value stocks. For instance, the Russell 1000 Growth Index was up 21% year to date versus 7% for the Russell 1000 Value. We also continue to see the large technology names, some of which I just noted, driving the markets, with artificial intelligence theme making investors excited for this new technology revolution.
Karen, I agree, and I would add that the AI chip maker you mentioned, NVIDIA, they were up 36% for Q2 and 150% for all of 2024. The growth has continued after the stock was up over 200% in 2023. I personally can't remember a time in my career where one stock was watched so closely. And while these percentages are staggering, only time will tell if NVIDIA can continue to beat expectations or if their growth will finally slow. One other thing to mention, international developed markets continue to lag those of the U.S. The U.S. market has the highest number of technology-type names, roughly 30% in the index. So when technology stocks do well, the U.S. markets tend to outperform international markets. It's worth noting that European elections, we're seeing shifts towards more of a populist state, and the uncertainty around future policy has weighed on these markets. With, for example, France had elections and their markets were down 8% after the June elections.
Thanks for the update about the international markets. I do want to look back and look at the U.S. briefly before we move on. Clients have had a lot of questions about market concentration, where the small number of stocks that are pulling the markets higher. Here's a chart from the JP Morgan that shows the S&P 500 index and breaks out the Magnificent Seven performance on the left in green versus the other 493 stocks in the index in blue. On the top right, you can see that the earnings from the Magnificent Seven for the past 2 years has dwarfed that of the remaining 493 stocks. However, JP Morgan is estimating that growth will eventually even out, which suggests the outperformance and concentration may be nearing its peak. Joe, you wrote a blog back in February about the Magnificent Seven not being a bubble. What are your thoughts now, given that these stocks continue to outperform the market?
Yeah, thanks, Karen. In that blog, we compared and contrasted the performance of the dot-com era from the late 90s, early 2000s to the Magnificent Seven of today. So that the key is that much of the dot-com era was mania around the future of the internet. And that did prove to be an enormous technology, just like we had thought. But the difference is that many of the companies that rallied and crashed because they were new businesses, but they were also really bad businesses. Think like Pets.com. The Mag 7 are large, well-established companies with big moats, high margins, and these are the ones that are poised to take advantage of artificial intelligence. Then the question is, why this magnitude of outperformance? And I wrote a blog about this in Q2, which we published on July 3rd. And there's a couple things to highlight. And the first is earnings. You already noted this, but the earnings that these mega caps have continued to show are just superior to those of the rest of the market. Another thing is buybacks. Goldman Sachs estimates that buybacks remain really high, roughly $5 billion per day, and that's about $1 trillion per year. And then Fidelity wrote that since 2009, the issuance of shares totals $2.7 trillion, with the reduction in shares at $21.3 trillion, meaning that $21.3 trillion of shares have been bought back, which is 10 times the amount that has been issued. So these levels of concentration, historically, though, don't last forever. But the question is, what would trigger the rest of the market to catch up? It's very likely that it would be earnings of these mega cap stocks if they were to roll over, along with the earnings growth from the other 493 catching up. So earnings is going to be key for Q2 and the second half of the year. But let's switch gears a bit. Now that we've highlighted the quarter, let's look at Wespath equity funds. And I'll note that in the Wall Street Journal wrote last week that 18% of active funds have beat the index this year, and last year was only 19%. The only way to beat the market was to overweight these 7 names, the Mag 7, which is not how we are positioned in our funds.
Correct. Our U.S. equity fund owns these mega cap names, but has a lower weighting to them versus the index. With this said, in this environment where these names are driving the market with their strong performance, we underperformed.
And what about the international fund?
As we showed earlier, international markets did not fare as strongly as the U.S., but they were in positive territory with emerging markets leading the way. But our international equity fund did not fare as well as the market and underperformed its benchmark for the quarter and year to date due to stock selection by our active managers. But before we move on to fixed income, I do want to highlight that our current Chief Investment Officer, Dave Zellner, and the incoming Chief Investment Officer, Jahara Farahadieh, will be talking later on this webinar about Wespath's equity performance. They're going to dive a bit into the deeper trends of the mega cap underweight and the outperformance of U.S. stocks relative to international stocks. So I think viewers will want to stick around for that.
So the fixed income markets have not been quite as headline-making as equities on the quarter, especially compared to the volatility that we saw in the market and rates in 2022 and 2023. Of course, inflation has come down from 9% to 3%. What is your update for bonds this quarter?
A good point to start talking about the fixed income market is by looking at the yield curve. And we borrowed this chart from JP Morgan, which looks at the curve at 3 other points in its cycle. July last year, when the inversion in the curve peaked. October 2023, when the 10-year was at its highest point. And August 2020, when the 10-year was at its lowest point. A good measure that helps drive the yield curve is obviously the inflation numbers. And you mentioned they're lower. Joe, tell us a little bit more about that, inflation.
Yeah, so you can see in this chart that inflation is leveling off and is closer to 3%, though that's still above the Fed's target. So you can see that the majority of the inflation is driven by housing, which is a little stickier than other things like, say, energy. So meaning it's going to take some time to reach the Fed's target of 2%.
I did see recently that the Fed updated its dot plot, which expects to deliver just 1 rate cut this year, which is down from the earlier expectations of 3 cuts.
Yeah, and after the inflation numbers from yesterday, I think the September rate cut expectations are now about 80%. So for 25 basis point cut. So closing out this section, I briefly want to look at the fixed income fund performance. You can see that the fixed income fund outperformed its benchmark for the quarter and year to date. The primary driver for outperformance has been the issue selection by our Core Plus manager and overweight to high yield bonds. The inflation protection fund did underperform for the quarter and year to date. The primary driver was allocation and issue selection to emerging market inflation-linked bonds and these currencies, especially the Brazilian real, which weakened relative to the dollar.
Thanks for the fixed income update, Joe, and thank you to our viewers for tuning in. For more detailed fund attribution information, please check out the latest monthly investment report on our website and tune in to Dave and Jahara's webinar discussion. As always, please feel free to reach out if you have any questions.
Hello again. I'm now joined by Chirag Acharya, Senior Analyst of Sustainable Investment and Stewardship. Welcome, Chirag.
Thank you, Joe.
Chirag, today we're going to talk a bit about shareholder engagement and proxy voting. More specifically, we're going to dive into a case study of proxy voting at a company that I bet many of our viewers have heard of or maybe have purchased their products recently. But before we do that, as a refresher, what is proxy voting? What do we mean when we say that?
Proxy voting refers to casting ballots at the annual general meetings of companies, or AGMs, in which we invest. Remember, as a shareholder, we are a partial owner of companies. That means that we get a say in company decisions. AGMs cover all sorts of corporate governance-related items, for example, board director nominations, executive compensation packages, and shareholder proposals submitted by investors. Another important tool to hold companies and their board accountable for delivering shareholder value and managing risk on behalf of investors. Also, most AGMs take place in the spring and early summer, so we just got done doing a lot of our proxy voting for the year.
So, Chirag, you and our colleague Lucas wrote a blog last month, and you referred to proxy voting being depicted like in TV shows like Succession. And while proxy voting may not normally be as dramatic as that, there are some things that viewers may have heard of, such as Disney this year, or the battle at Tesla over Elon Musk's pay package. So these are real issues, and they bring in a diversity of voices and perspectives. So we had an issue of our own that garnered a lot of attention this proxy voting season, and it had to do with human rights concerns and the supply chain at Mondelez. Can you tell us more?
Right, Joe. So first, you mentioned earlier that a lot of viewers have probably heard of Mondelez. This is the company that owns Oreo cookies, Cadbury, Ritz crackers, Triscuits, and a bunch of other snacks and candies. We did try to engage Mondelez and ultimately filed a shareholder proposal because we had some concerns about human rights risks in the company's operations. This mainly stems from the company choosing to operate in Russia and Ukraine and not relating to investors how they're mitigating the risks of continuing their operations in the region, while many of their competitors ended up leaving the region. And unfortunately, Mondelez still sells its products there and has facilities and warehouses in Russia. So here's the bigger picture. We're looking for more transparency from the company about its operations in conflict-affected areas, or CARAs.
So CARA, that's a key term there. Can you help us understand what is a CARA?
Good question, Joe. So CARAs are where there may be ongoing wars, armed conflict, political unrest, or harms to the local civilian population. In other words, areas that face heightened risks of human rights abuses and violations of international humanitarian law and international human rights law. Some examples would be Russia and Ukraine, Israel and Gaza, the Democratic Republic of Congo, and the Xinjiang Uyghur Autonomous Region in China.
So what's the risk for shareholders like Wespath here? So you mentioned that Mondelez did not pull out of Russia while some competitors had. And from a business perspective, it may sound like an opportunity for Mondelez to gain market share, sell more product, and some shareholders may like that. So why do we think differently?
There are numerous risks to doing business in conflict-affected high-risk areas. For example, deaths and injuries to civilian populations, destruction of assets, weak state control, and supply chain disruptions. These can lead to material risks that hurt bottom lines and investment returns. Regulatory risks, legal risks, operational risks for all affected parties, including corporations and shareholders. This is not just a hypothetical. A Mondelez factory in eastern Ukraine was temporarily closed after sustaining significant damage by a Russian military attack. That's a risk to employees and operations. Also, Mondelez has generated more than $173 million in tax revenue for the Russian state since the invasion began. This could create the perception that it is helping funding the war efforts. Finally, let's remember that Wespath is one of the world's largest faith-based investors. In line with our Methodist values, we do have a deep moral concern about conflict anywhere.
It's great. Thanks, Chirag. So, as you mentioned, we ended up filing a resolution on lease. So what were we asking the company to do, and how did the voting results turn out?
We asked for a third-party independent report assessing the effectiveness of the company's implementation of its human rights policy for operations in conflict-affecting high-risk areas. That's another thing to keep in mind. We're not telling companies outright to not do business in Russia, but we're saying, hey, be authentic and transparent about how this aligns with your commitments. Make sure you're doing what you've said you'll do. Our proposal ended up getting over 30% support from shareholders this year. That may sound disappointing, but it's actually a big number for a first-time resolution. We think that this gives us a strong case to bring back to management to keep engaging the company.
So great. Thanks, Chirag. We will look forward to an update on this engagement in the future.
Thank you, Joe.
Well, hello again to our investors and webinar viewers. I'm joined now by Wespath's current CIO, Dave Zellner. And you've already heard some interesting webinars and heard from our colleagues. Thank you to Joe, Karen, Hua, Frank, and Chirag. They shared their perspectives with you, as well as the depth and breadth of the work being done here at Wespath. And now I feel very fortunate to spend time with you, Dave, on your last webinar here at Wespath. Your retirement date is around the corner on August 1st. I'm excited to be here with you. It's been a very interesting time in the economy, geopolitically, the markets, but even more specifically to our Wespath funds. And so I've been asking this question of the team lately, and I'm grateful that I have the opportunity to ask it of you. How are you feeling right now?
Thanks, Johara. Hello, everyone. It is good to be with you for my last webinar. It's bittersweet, having been with Wespath for 27 years, to sail into the sunset, so to speak. In a couple of weeks, but I've really enjoyed my time with Wespath and the support we've had from our board of directors and the culture and interacting with participants and interacting with clients. It's really been very personally meaningful to me. Now, all that said, I do wish that I would be going out on a high note in terms of relative performance, particularly when we look at the equity funds. The performance certainly has not met our expectations. I wish I could have gone out on a high note that we had at the end of the pandemic year, where we shot the lights out relative to the indexes. But, we're in it for the long run. We have a long horizon. And I'm really confident that the discipline that we have in place here at Wespath will continue into the future, and that the team under your guidance will be in great hands.
Thank you for that, Dave. And really, we both know as CIOs, underperformance, outperformance, it's all part of being an investor and going through these different market cycles. So I think it is important for us to stay disciplined as CIOs, especially during these times when there is significant underperformance.
I should point out that before I came into the webinar, I did some research to see how the Oracle of Omaha has performed in the past. Because, the reality is that the period that we're experiencing right now with all of the hype around artificial intelligence is really similar to what we had at the end of the 90s.
And Dave, one of the things that I keep thinking about is these valuations with these magnificent sevens. I think about it on a daily basis, and now you're starting to see that we're questioning, these high valuations. And I get to this place of, the minute Dave walks out the door, his philosophy, his strategic biases will all of a sudden play out. And unfortunately, you won't be here for that.
Well, and going back to Warren Buffett, at the end, in January of 2000, CNN put out a report, an article, and the headline was, Buffett hits a bumpy road. And when you looked at his performance for Berkshire Hathaway up until the end of the 20th century. For the 3 years prior to December 31st, 99, his fund had underperformed the S&P 500 by 9 percentage points a year.
Yeah.
And for the 5 years up until 1999, it had underperformed by 6 percentage points a year. So, curiously, for the next 3 years, his fund outperformed by 24 percentage points. His return was a positive 9% compared to negative returns for the S&P, and for the 5 years, it was another positive 9.5% compared to a negative return for the S&P 500. So, investors go through cycles. And
let me bring it back to you on this specific Wespath fund.
Sure.
So, our U.S. equity funds, specifically active equity managers, have been challenged, and it's primarily driven by, the Magnificent Seven, and specifically within our funds, we're underweight.
Yeah.
Okay. And then another sort of perspective is really the non-U.S. versus U.S. U.S. has been dominating from a performance perspective, and our multi-asset fund has been underperforming. We have a significant allocation to non-U.S. In hindsight, and as a CIO, I'm not athletic, but I know that's something called Monday morning quarterbacking.
Yeah, right.
It's not fun to look back, but it's great lessons to learn. Hindsight, anything you would want to share in sort of how we've structured the funds or anything related to the performance?
So, as you know, we've developed a set of mega trends, which we think are these topics that will have a long runway to fruition. And one of them, for example, is the modest and sustainable growth in the world economies led by the emerging markets. In hindsight, one of the mega trends that we probably should have thought through was the American exceptionalism. So, for example, we've been exceptional in terms of the extent to which we've been able to develop technology, particularly artificial intelligence. We've been exceptional in the extent to which we've been having meaningful fiscal stimulus that we've been able to implement without having a negative impact on our currency. In fact, our currency keeps getting stronger and stronger. We've had exceptionalism in terms of the number of immigrants that we can absorb, when combined with our fiscal stimulus has led to GDP growth that's been the envy of the world. And so in hindsight, this American exceptionalism is a mega trend that, at least for the last several years, has positively influenced not only returns of individual U.S. stocks, but the U.S. market compared to the international markets.
And right now, the team and I are focusing our research on whether this American exceptionalism will continue into the long term, the next 10 years, 20 years. And so we take this disciplined approach, really leveraging the great foundation you've left us, Dave, and spend some time, researching, and then also really doing due diligence again on the managers that we've selected to make sure they're the right managers for the next 10 years, and then focusing on fund construction. I always love bringing it back again to asset allocation or fund construction, because as you know, Dave, that 80 to 90% of the returns are going to be based off the fund construction. And so I think it'll be important for us to get it right going forward, especially for the multi-asset fund and some of our other great funds that we have.
Absolutely.
And so I'm excited. I'm really grateful for the legacy that you've left me and the team, the great team that we have at Wespath. And so going into the future, I hope you still have your phone available so we could give you a call whenever we need to. Thank you, Dave.
Thank you.
All right, so Dave, you and I have sat across from each other at this table, or those very two low chairs, several times, and we're normally talking about markets and we're talking about the economy, but today we're going to talk about something different. We're going to talk about the early part of your esteemed career here at Wespath.
Right.
So we have a couple of different things we wanted to ask. And one of the first questions was, how did you find the job at Wespath and how did you end up here?
Well, throughout my career, I've been subject to serendipity, and it was kind of serendipitous on how I found the job. I had moved to Chicago from Houston with my family with another very small firm which wanted to move to San Diego. And they ended up moving to San Diego a year after I relocated to Chicago and the family relocated to Chicago. And so I was in San Diego by myself. My family was here. We were thinking of the family would stay here for another year and then move to San Diego. But I saw an advertisement in an industry rag called Pension and Investments, which we both get.
And which you have several editorials in.
And the job was 3 miles away from where we lived in the Chicago area. So I figured I had to throw my head in to see if I could stay in the Chicago area. And the rest is history.
And where and what year was that?
It was 1996 when I saw the advertisement.
So this was probably pre-people posting jobs really on the internet, and there was an actual physical industry like the ones that we have in the office,
Yes.
physical P&I.
Right. And what happened was back then, people that were looking for jobs, that was the place to go. When P&I would come out, people would open it up and see what jobs were available.
So you sent in your CV or your resume, got the job, and you came to Wespath in the late 90s then. And what was Wespath like then? What was your first week, first day, first year like at Wespath?
Well, I mean, I'd been a lifelong Catholic. I can tell you I could count on my hand the number of days I missed going to Mass on a holy day or Sunday throughout my entire life. So I was a very religious Catholic, and I was really wondering, okay, what am I going to have to do different now that I'm working for the United Methodist Church? And so that was the first thing. But the second thing that I was really struck how friendly people were. And so back when I worked for Shell and I worked for the investment management firm, I would come in and go straight to my office and settle down and start reading my mail and talking to people about various topics and setting up meetings, whereas I would walk in and I never forget that Renee, one of my favorite former colleagues, she would say, "Good morning, Dave Zellner." And I realized that the culture was one of being very friendly and open and engaging with others. And that was something that I just wasn't accustomed to in previous jobs.
Part of that church DNA, culture-wise, right? Well, so we have several people that you're going to talk to today. The next one after me is going to be Eileen Kane, our Chief Financial and Strategy Officer. So we look forward to hearing more about your time here at Wespath.
So it's hard to believe this time has come. Feels like forever ago, but we're going to start back with the dot-com bubble and the 2000s, maybe even a little bit before that. But when did the craze surrounding the dot-com stocks start in your mind?
With America Online. That was the one that I couldn't help but notice when I started working with Wespath. And I looked at our portfolio, our total holdings. AOL accounted for like 3% of all of the assets. Virtually all of our managers held a position in America Online. And that's what really had me concerned. And one of the interesting stories is I was so convinced that AOL was not going to be the next biggest thing, but I wanted to hear from different investors what their views were. And this was right at the beginning of these online blogs. And I remember going on in a blog and asking, so what is the expectations for your returns for America Online for the next 10 years? And I got all these ridiculous answers, one of which was, oh yeah, the stock is going to grow 60% for the next 10 years. And so that I did the math to see that if that were the case, then AOL would be accounting for like 30% of the entire economy, the entire world economy. Knew that wasn't possible, but there are a lot of other stocks similar to AOL that were just getting a lot of hype. And it just seemed to me that that was a period that was that type of performance for those type of stocks was just not sustainable.
What other elements of the .com era do you remember beyond AOL? Anything else in terms of the hype or?
The thing that I remember was you would pick up pension investments, which is an industry rag, and you would see a lot of plan sponsors that were moving out of international into U.S. stocks, and the rationale was, well, we've got Microsoft and Apple and Coca-Cola and Procter & Gamble and Kimberly-Clark. They all sell their products to foreign companies, so let's move to the U.S., get out of international. And then this is a new paradigm. Growth is going to be the story going forward. So let's focus and concentrate more of our portfolio in growth. And so that just blossomed into more people putting more money into the same stocks that were performing really well.
Similar themes sometimes these days as well.
Right.
I know for me, remembering back, this was around the Y2K hype was also starting around the same time as the .com type stuff together, of course. It was an operational level of chaos for us as the organization. It's very grateful to have you join the team and be another sound mind person that was helping us navigate through. To remember those days, we were first starting out, changing to the SunGuard platforms, making every other type of operational change and going into crisis. It was certainly the world was in a bit of a craze with the .com, and we were in our own little level of craze.
Yeah, lots of anxiety over the potential of planes dropping out of the air when we shifted to the year 2000.
Yep. Are there companies whose rise and downfall for you really stand out, whether it be specific to the .com or just in general?
The whole pets.com and the various internet companies that came out that really didn't have much in the way of generating much in the way of revenue, that people were evaluating companies on the basis of clicks. How many clicks does a website get that help determine the value of the stock? It's about dollars per click, which was an odd way to value companies.
It seems to me like, as I think about this time and certainly about our journey together forever, we've weathered some storms. Certainly .com was one, the Great Recession, most recently COVID, and I certainly have many fond memories of the work that we did together. I also have some thoughts about how we started out with how we're going to survive these things. But as you think back on those events, are there key things that you think helped get us to the other side more significantly, or key things that you always rely on you'd want to impart wisdom on the others as we inevitably face future crises?
Stuff happens. And every time stuff happens, people believe that this is the beginning of the end of the world. And there's some people sell now, ask questions later. And while what I've seen over the years is that people often make a good decision on when to sell and get out, and that things continue to get worse after the sale. But then what happens is that there's this narrative that evolves that says things are going to continue to be bad. And then you see, whether it's stocks, bonds, real estate, whatever, things start to recover. And the narrative that's continuing to go along is, no, this is just a dead cat bounce. Things are going to continue to be bad in the near future. And so those that sold don't get back in when prices start returning. And then prices continue to climb, continue to climb, continue to climb, and finally, those that sold make a decision to get back in, whatever market it is, but they get back in at a price that's way higher than the price at what they sold. Whereas they would have been much better off if they would have just ignored the noise, remained invested, yes, experienced the pain of seeing additional declines, but once the market rebounded, they would remain invested and they wouldn't end up being worse off financially because they waited so long to get back into the market.
Sad seems to me is that they need to be able to experience one of those really big lessons learned in order to then experience it the next time around. So I guess it means they have to live through a number of crises like we have.
Well, and, sometimes they're longer to recover. So like you started out, Eileen, asking about the dot-com bubble. That burst in February, March of 2000, and stocks continued to decline for the next 3 years. It wasn't until 2003 that the market turned around. But then you look at what happened in 2008. That was from fall of 2008 until March of 2009, and then we started to see a recovery. And then you look at COVID, where the market cratered in March, April, and then started an immediate recovery. And so every recovery is going to be different. And again, in all of those cases, there were a bunch of people that sold, but it just took them a long time before they entered the market.
I know I've certainly grown to really respect your ability to stay calm in those crises, to lean into calming others and to hold to your convictions. I think for me, when I think about anyone I'd want to live through a crisis with, you certainly are one of my top people, and I really have appreciated that wisdom that you have not only imparted on me, but I think benefited all of our clients with your calm, steady hand in ensuring that we can navigate those waters together. So
thank you.
So Dave, I'm here to talk to you about some of our sustainable investment activities, and specifically our joining and helping to be one of the first signatories to the Principles of Responsible Investment. Now, a little bit of context for Principles of Responsible Investment. It is now representative of over 5,000 investors, institutional investors, and over $100 trillion in assets. It's the largest responsible investment association and coalition in the world. But it was a little bit smaller when Wespath joined in 2006. And so you and Wespath were one of the original founders and signatories. And this was happening at a time when a lot of people hadn't heard about sustainable investment or environmental, social, and governance investing. So I'm just curious to hear, why did you get involved at a time when this was so nascent?
Yeah, so not only were we a founding member, but it was just a vision of then Secretary General Kofi Annan to have the Principles for Responsible Investment. And so they wanted to identify about 24 investors from around the world to come to formulate what the principles would be. And at the time, the leading responsible, socially responsible investment organization in the U.S., and to a certain extent the world, was the Interfaith Center for Corporate Responsibility. We've been longtime members of ICCR, and we were the largest asset owner and one of the most active asset owners. Our director of corporate relations at the time was on the ICCR board. And so when the United Nations was trying to identify the leading investors around the world, it was natural to ask Wespath. And the invitation came to me. And at the time, I really, even though I had been with Wespath for about 8 years, I really wasn't as focused on integrating sustainable investment practices into the investment process as I am now. And so I thought that this would be a good opportunity for me to help craft the principles as well as learn, because I would be interacting with people from all over the world. Australia, UK, Europe, Asia, South America. And so that's what originally got me interested in participating in the PRI.
So you talked about wanting to learn and wanting to be influenced by this process. So tell us a little bit about how you were thinking of sustainable investment before you got involved as that PRI signatory, and then how that process of working with other asset owners and managers changed how you thought about it afterwards.
So when I started, when we talked about responsible investment, our approach was what is morally right. We would look for corporate business practices that didn't align with the values of the church, and we would advocate for changes that morally aligned with church values. But what I really discovered after interacting with folks from overseas, that these were business people. They weren't members of religious organizations that focused on moral clarity. They were business people that focused on what was best for business practices. And so for me, the light bulb went off. Gee, there are things that we can ask companies and governments to do that can make a difference, that will result in a more sustainable world, which will eventually lead to better investment results for our participants. And so again, that was the light bulb moment that said, there's a way that we can integrate the consideration of environmental, social, and governance factors to provide better returns for our participants.
So this light bulb moment goes off and you have this conviction. And I know from hearing from some of our asset managers and talking to various peers and partners that you then go out and share the good news, so to speak. And that you have a lot of conversations and a lot of different discussions kind of telling people about some of the vision and the potential for sustainable investment. Do you have a couple of anecdotes that stick out in your mind for the type of conversations you were having with people?
Well, I mean, there was one that virtually everybody we talked to brought up in our conversations. So we would approach asset managers and we would say, there's this principles for responsible investment. The goal is to promote the consideration of environmental and social governance factors in investment practices or in business practices that will eventually result in a more sustainable business. And the response that I always received was, we are a prudent fiduciary. We have to do what's in the best interest of our stakeholders. And so to consider ESG factors is something that would violate our fiduciary responsibilities. And my response to that was, I would ask a question. So if Exxon had another oil spill similar to what happened in Alaska several years ago, would that be good or bad for investment performance? Well, that would be bad. And if a company was had a poor safety record and their employees were significantly injured relative to a competitor, do you think that would be good or bad for business? Oh, that would be bad for business. And so I would give a bunch of other examples, and eventually they would agree, yeah, all those scenarios that you laid out would be bad for business. And so then they would have their light bulb moment to say, well, okay, we do consider those things in making investment decisions. And so that just naturally led to them taking a role of learning more about what responsible investment was about and how to ensure that when they made investment decisions, that they were doing so in a manner that promoted long-term corporate sustainability.
And in the 18 years from 2006 to where we are today, under your tenure, what are some of the proudest accomplishments of what Wespath has done on sustainable investment that you look back on?
I mean, I got really lucky hiring some really sharp, brilliant people in terms of understanding what it means to be a sustainable company, a sustainable investor. And so I look at what was originally the Sustainable Accounting Standards Board, and that was to complement the ultimate goal of the Sustainable Accounting Standards Board, or SASB, was to complement financial accounting reporting with relevant material sustainability metrics, and to encourage companies to report out on this information so that investors that were making investment decisions understood what the risks and opportunities were for various sustainable related issues. And so a member of the team and myself, we were very involved with the origins of SASB. And it's been gratifying to see the adoption, the broader adoption of those standards. Now that has evolved into a different organization, but the concept is still the same, to have have companies report on material sustainable factors that have an impact on long-term corporate sustainability.
Well, Dave, as one of those individuals who is lucky enough to be under your tenure and to benefit from Wespath's leadership on this role, you're going to be missed. Your red pen is going to be missed. Fights on proxy votes is going to be missed. But we're excited to carry your tradition forward and to continue to push on these issues using the foundation that you have so thoughtfully contributed to and built over the last 20 plus years. So thank you.
So Dave, can you tell us when you realized the market for institutional investment?
It was, so you'll remember Derek,
Yes.
Who dubbed the term bluebird calls, which he described as we would get phone calls from people out of the blue asking us if we could manage their assets. And so these would be institutions, various institutions, United Methodist institutions that had employees that were enrolled in our benefit plans and saw the type of funds and the returns that we were achieving. And so they were members of different institutions, and they would say, well, we think that Wespath, which was General Board of Pension and Health Benefits at the time, manages institutional assets. And so we would get these phone calls without us doing any proactive outreach to the various institutions. And so given the fact that we were getting a number of organizations calling us, asking us if we would be open to managing their assets, we figured, what if we proactively marketed to try and attract additional institutional assets? And so that was really the impetus that led us to pursuing an institutional business, an outsourced chief investment officer type of business on behalf of Wespath.
So once you realized that market, what were some of the challenges that you saw and had to address in order to launch the institution?
And I don't know that I would say that it was so much that I identified, but we hired an external consultant, and they came in and they reviewed from top to bottom our service offering, how we described our service offering, the people, and they made a list of comprehensive recommendations on what we needed to change. One of which was to strengthen the team, to have a larger team of seasoned investment professionals that could demonstrate their skill and experience to the institutional investors. So that was one thing. And then a second thing was how we communicated. We think we did an okay job in terms of describing our offering, but once we brought in professional communicators, they really polished up the what we offered. And then, of course, there was the focus and the need for having superior client service. And certainly you were one of the first that we brought in to help us provide superior client service. And so those were some of the things that we had not been accustomed to that we needed to bring on in order to be successful in attracting institutional assets.
So as you look back over the launch, the initial launch of Wespath Institutional Investments and the I-Series of funds, what has been the most rewarding aspect of that?
I mean, for me, it's absolutely interacting with the clients. One of the things that I really enjoy is speaking with groups and explaining in language that the average trustee can understand on what's transpiring in the markets and the economy and asking their questions. I just personally, I feel a lot of satisfaction in help. I've been really excited, and I love investments in the economy, and I really like sharing that with other people. The goal is they can walk out and they say, now I understand a little bit more, and I could explain it to someone else.
Seeing that light bulb go off. And I would say for me, it's been the stories that come back of how the investments are helping to further their mission, whether it's scholarships for students that are in college or some type of humanitarian relief if there's a disaster, just helping out in their communities. So that's
absolutely.
rewarding.
The mission of the church is to make disciples and transform the world. And to the extent that we are helping organizations fulfill that goal and mission of the church to transform the world through the various initiatives that you outlined, that's one of the things that I talked about is there's a part of the I get compensated in terms of salary, but there's also what is really been very important to me and what gives me a lot of satisfaction is what I call psychic compensation, is knowing that you help others make a difference in the lives of people around the world.
Well, thank you, Dave.
All right, Dave, so that was fun, and thank you to Jake and to Crystal and to Eileen for recapping a lot of the more important memories that you had in your time here at Wespath. We want to ask a question that a lot of people have been asking that we all want to know, including me, is what are you going to be doing with this new free time to someone that works 6-7 days a week? What are your plans?
Well, earlier when we talked, Joe, I mentioned that serendipity has been kind of a theme throughout my life, and so I'm going to let serendipity take its course. I mean, you know that my children and grandchildren live in the Seattle area, and so I've got a home in the Seattle area where I'll be spending more time. But I definitely want to learn to cook more. I can bake reasonably well, but I can't cook hardly at all, and I prepare the meals in our household, and so I want to learn to cook more. I like playing bridge. I'll play bridge. I will continue to be engaged in the markets. I chair a faith-based charity out of the UK that's focused on helping faith-based institutions around the world invest their money in alignment with their values. And so I'm looking forward to spending more time with the charity to help them achieve their mission. And then,
are you still going to be getting up before 6 a.m. and getting to the gym?
Probably, yeah. I mean, I really don't want to do that.
Viewers
I
should
really
know that.
want to be able to sleep until 6 or 7 o'clock.
But viewers should know that whenever I travel with Dave, he's always intent on being at the gym, particularly before everybody, but most in particular before me, which usually means I have to get to the gym before 5:30 to beat Dave. So
Yeah, I mean, again,
I'm
today,
sure you're going to keep that pace.
Yeah, again today it was 4:30. I'm awake, out the door at 5:15, and but I'm really hoping that I can sleep later.
There we go.
The idea is to not have to be a slave to a schedule.
Well, thanks, Dave. This has been fun, and I think it's really nice for people to get to see the recap and highlights of your career.
Thanks, Jim.
But we do have one more thing that we want to show you.
I remember meeting you at the first investment forum that I attended in Chicago nearly 10 years ago. As you introduced each speaker, I could see you absorbing their wisdom like a sponge. It was as if we could see the information physically coming towards you. Your passion and dedication for investing was evident, and I knew at that time our portfolios were in good hands. Despite your incredible wealth of knowledge, you've always been gracious in answering questions from those of us less versed in the investment world, and for that, I am grateful. Another memory that stands out is when you, Karen, Diane Weller, and I were preparing a webinar for our Dakotas, Minnesota account holders. After the practice run, Karen asked for your feedback on her section, and you responded with, "I might have used a few less words." True to your style, Dave, you are a man of few words, but you hire well. We're blessed to work with Karen, Evan, Joe, Crystal, and everyone at Wespath. You've built a fantastic team for Johara as she takes the reins of the legacy that you've built. Again, congratulations, Dave, and best wishes as you enter into this next chapter called retirement. Blessings to you on your new journey.
It's hard to believe that your time for retirement has finally arrived. The years you spent at Wespath provided an expertise that few had seen before. Your dedication to the United Methodist Church and its values have helped create investment funds that foundations like mine can happily support. Your leadership skills help cultivate an exceptional team of experts and individuals who truly care for the customer. It's an honor and privilege to work at Wespath with you, and I hope that I'll get to spend some more time with you here in the desert Southwest now that you've retired.
Hi, Dave. I heard you were retiring, and I wanted to pass along my congratulations. You've certainly had a lot of big accomplishments throughout your career, everything from PRI to PSP. By the way, I still love that program. I remember when I was there, we engaged a lot of companies on ESG topics. You know, I also remember all the glamorous field trips. You sent me to an oil sands mine in Canada, a bulldozer factory in Peoria, and you were this close to sending me to an industrial pig farm in Iowa. You sent me to a jail. Jail, Dave. And then you sent me to General Conference. I also remember a few battles over the written word in pursuit of, what was it called? Ah, yes, highest professional standards. I don't know if we ever really figured out what that was, but one thing I did learn is that passive voice is evil and must be destroyed in all circumstances. And here's how well I've learned that lesson. I was helping my daughter with her resume and some cover letters recently, and she made the comment, "Wow, Mom, you're really good at finding passive voice." Thanks, Dave.
One of the most anticipated presentations of any Wespath forum was Dave Zellner's investment outlook. Who could forget his top 10 list and acronyms like AI and BRICS and Brexit and ESG? They were entertaining, informative, and instructive. Dave, thank you for your disciplined and unswerving approach to investment management. Thank you for your steadfast commitment to staying on course in the midst of all of the noise around us. Thank you for your strategic initiatives on socially responsible investing. And most importantly, thank you for caring about our community and helping us be more effective stewards of the mission and ministry of the United Methodist Church.
Dave, congratulations on your upcoming retirement. I have known Dave all the way back when he started at Wespath. Over the years, we learned a similar interest in running and economics. Dave has always been a calming influence during the major financial market swings that have occurred over the years. His mantra in investing for the long term carried us through the volatility of the markets to stay the course. This has benefited our pension board's investments immensely. I think one of the most impactful results of Dave's tenure is the implementation of life-stage investment income back in 2013 that continues to play an important part in the existing and new retirement programs. Sure makes it easier for most clergy that don't want to manage their money in retirement. I always look forward to Dave's top 5 or 10 world economic issues at our annual gatherings. I will miss these presentations from the macroeconomic perspective. I hope we can get in touch when he comes back to Seattle. Not sure I'll be up for a run, but it will be good to catch up. Congratulations, Dave.
Congratulations, Dave, and thank you for your dedication in investing wisely for the foundations and churches across the connection.
Many blessings to you and your family as you start this new chapter. Congratulations, Dave.
Congratulations, Dave. I'm really happy for you. Take a bow, Zellner. Well deserved.
May God bless you during this next chapter of your life. And if you happen to publish an anthology of your top 10 list, I'll be in the line for a copy.